Hi, welcome to the second lesson. In this section, we are going to talk about bonds. So what are bonds? Bonds are IOU contract, meaning you are lending some organization money for a given amount of time. So bonds are also considered one of the safest investment compared to many other asset classes like stocks and commodities. Since you are lending money, you are paid an interest periodically. This interest is called coupon. Typically, bonds are issued by government or organization like businesses. And each bond has a maturity date associated with it. The maturity date is when the contract expires. So when a bond matures on maturity date, the initial money you lent will be paid back to you. Now, the best way to own a bond is through buying exchange traded fund, or better known as ETFs. Bond ETFs work slightly differently from a real bond. They don't have a maturity date associated with them, and you can sell them whenever you want to. Usually you get a monthly payment, which is essentially your coupon payments. Some of the well-known bond ETFs are listed in the text below. Please make sure you take some time to go through them. So let's switch our focus to the factors affecting bond prices. There are 5 factors. The first factor is the interest rate set by central banks. Okay? For longer term bonds, meaning bonds with longer maturity date, if the interest rate moves higher, those bond prices will start falling. Very short-term bond will not be affected too much by interest rate. The second factor is coupon rate of the bond. The higher the coupon rate when compared to the central bank interest rate, the more likely the bond price will go up. The reason is higher coupon rate becomes attractive to investors and everybody starts buying it. So this pushes up the bond price. The next factor, unexpectedly, is fear in the stock market. If there's fear in the market, it will push the bond price upwards. Because bond prices are typically seen as safer investment compared to stocks. When investors start dumping their stock, they switch to buy bonds instead. The fourth factor is the number of bonds being issued. This is a supply and demand problem. Typically, demand stays constant, and when supply of the bond goes up, bond prices starts to fall. Lastly, the bond default risk is also a big factor. Defaulting on a bond means that the borrower cannot pay the interest or the principal back to you. The larger the risk of default, the cheaper the bond becomes, which ultimately makes the bond coupon yield higher. The intuitive explanation for this phenomenon is simply when people take on more risks, they want a higher return. Now, due to the limited time in this course, we cannot go into details about the reason why. We will cover this in another course. So there you have it. These are the 5 most common factors that affects bond prices. Make sure you read the text as there are a few extra topics covered in the text. In the next section, we will start introducing stocks. So see you in the next video.